Hello, everyone, and welcome to our podcast at the MIT Center for Real Estate. Robbie Mulcahy here once again. I'm a first-year student in the Master of Science in Real Estate Development program here at MIT. On the pod today, we have none other than Willy Walker, Chairman and CEO of Walker Dunlop. Very briefly, Walker Dunlop, which started as a small family-owned business in the late 1930s, has grown to become one of the largest commercial real estate finance and advisory firms in the United States and internationally. Walker Dunlop is listed on the New York Stock Exchange, and in its first 10 years as a public company, its shares have appreciated more than 800%. The firm was also on Fortune's 2017 list of fastest growing public companies and has been named a best workplace for 8 of the last 11 years by the Great Places to Work Institute. Willy earned his MBA from that other school here in Cambridge, the Harvard Business School, and sits on the board of the U.S. Olympic and Paralympic Foundation and on the Harvard Business School Board of Dean's Advisors. Most relevant, perhaps, to this setting, Willy is also the host of the Walker Webcast, an interview format podcast that hosts a diverse network of leaders to share business wisdom that cuts across industry lines. Personally, it's one of my favorite all-time podcasts, and for anyone in real estate, I find it to be required listening. Willy, it's such a pleasure to have you on the pod today. Thank you for being here with us.
Thanks for having me, Robbie. Nice to be here.
Great. Now, there's two broad places I think we could go with this conversation today, Willy. First is your story, how you got to where you are today, the pivotal moments in your career, the people who guided you, all with an eye towards how our listeners can learn from your experiences. And the second, I think, is to discuss the state of the commercial real estate market today on what are the metrics you're closely watching, the verticals or the geographies that excite or perhaps give you pause. So hopefully we'll have time to get into all of that, but let's start from the beginning. Let's have you start talking and me stop talking so that the guests can hear what they came here for. Please, if you could, walk us through your story. I'd love to hear from the beginning how you started in the business and the path that took you to where you are today.
Oh, you don't want to hear all that. You really don't. It's long and convoluted. It is different in the sense that I didn't grow up in the commercial real estate finance industry and did a lot of stuff for about a decade out of business school before joining the company that my grandfather started in 1937. I would say that whenever whenever people are hearing the intro and then all of a sudden they hear, and the firm was started in 1937, they're sort of like, hang on a second, like, hold on, how does that work? In the sense that I remember when I was fortunate enough to be awarded the Ernst Young Entrepreneur of the Year award back in 2011. And I think Walker Dunlop at that time was a 75-year-old company. And in my acceptance speech for the E&Y Entrepreneur of the Year award, I was like, it's almost an oxymoron that someone could win an Entrepreneur of the Year award for running a company that's 75 years old, because everyone thinks of entrepreneurship as you wrote a business plan and Mr. Hewlett and Mr. Packard were in the garage in Palo Alto and created this great company. And I think one of the lessons that is very important is you can be entrepreneurial with any company, with any job within a company, with any group inside of a larger company. And I think a lot of people sit there and sort of say, okay, it's hard to, make a real difference or act in a very entrepreneurial way. And I would counter that dramatically. There are lots of ways to be entrepreneurial, no matter where you are, whether it is a business plan on a piece of paper, or whether it's being part of a major global player that has tens of thousands or hundreds of thousands of employees. You can still be very entrepreneurial in those settings. I think the other thing for me, Robbie, is this, that, I never thought I would join the family company. Before going to business school, I lived in Latin America and worked in Latin America. When I got out of business school, I went back down to Latin America. I spoke fluent Spanish. I think my dream was always to run some big global multinational business and had no interest or focus on going to the family company. And so after having run and started some businesses that were far bigger than Walker and Dunlop, there was a moment in time where I was living in London and we just had our first child. And after basically spending most of my adult life feeling no sense of quote unquote being at home, if you will, wanting to go out and see the world and adventure and take any job that seemed exciting and would give me the most opportunity to learn and to earn and to grow. All of a sudden, this kind of homing device went off and saying, "Hey, it's time for you to get home. It's time to kind of get back to your roots." And so, I said to my dad, I was on the board of Walker and Dunlop at that time, and I'd just done a strategic offsite with the senior management team. And it looked like there was lots of opportunity for Walker and Dunlop at that time. And so I turned to my dad and I said, I think I could help you. And my dad said, "I've always known you could help me. I just didn't think you had any interest." And I said, "I really haven't. But at the same time, I really feel like I want to get back home and maybe I come help you." And the key to that working as well as it did is that my father had, I would say, I use this word, probably maybe it sounds a little bit too heavy, but my dad had suffered from having a father who didn't relinquish control of the company probably as early as he should have. And my dad had to really, really earn his chops to be able to take over Walker and Dunlop, having gone straight from the University of Virginia into Walker and Dunlop and never had any other work experience. Because I'd gone out and done a lot of other things and run much, much bigger enterprises. When I showed up at Walker and Dunlop, my dad literally handed me the keys to the office and physically moved out of his corner office and gave it to me on my first day being at the office. So he didn't want to not only give me authority, he physically wanted everyone in the company to know who sort of was running the company. And while I walked into my first Monday morning production meeting knowing nothing about the way that we actually went and did our business, I think there was a certain amount of bona fides that I brought with me into that role where people said, "Hey, he was just running a company with 3,500 people and a $250 million P&L. I think he knows what he's doing," even though I knew nothing about how to sell a piece of debt to a local owner operator in the Washington, D.C. region.
That's great. So much there. First of all, I really appreciate that winning the Entrepreneur of the Year award for a company that had been in business for decades is something that is a lesson, I think, for all of us, especially here as students and mid-career professionals who listen to this podcast, being an entrepreneur, right, at a business, and knowing that it's never too late to be a change maker or to light that fire that can, I don't know, set you on course to something completely different. So it sounds like you got into the business because you felt like you had ideas in your head about places that you could take Walker and Dunlop. Do you think that came from a place of being in finance and thinking Walker and Dunlop is a finance company, I know finance, or was there something about commercial real estate that drew you to the company?
Oh, I'll tell you, there are two things. One is that I realized early on that when I was working at Morgan Stanley, I was a summer associate in Morgan Stanley in summer of 1994. And I think when I was at HBS, 300 people applied for a summer internship at Morgan Stanley, and 6 of us were lucky enough to be selected by Morgan Stanley to come and get a summer internship. And out of the 6 of us, 2 of us got full-time offers coming out of the summer. So I felt very lucky and honored that not only did I get the opportunity to work at Morgan Stanley for the summer, but that they offered me a job full-time coming out of the summer. But what I realized that summer was that I looked around the associate bullpen and there were 25 of us. And I think 24 people were better at Excel modeling than I was. 24 people enjoyed Excel modeling more than I did. And I would go to meeting after meeting with companies. And what I found myself drawn towards was talking to the CEO about strategy and about leadership and about where the company was going, and not the DCF on, we use this WAC to get to that DCF, and this is what you ought to be doing from a capital allocation standpoint. And so after having had that experience and not gone back to Morgan Stanley, when I was working in private equity with TPG, the exact same thing happened, where there were all these people who'd been at Morgan Stanley and Goldman Sachs and other places who'd gone to TPG. And I would see them running models on financial structuring of companies. And I would do it and could do it, but I knew that their passion and interest was in being in that role of sitting there and saying, we can do an LBO of this company and put this amount of debt on it, and this is what's going to happen with EBITDA. And I was always on where are the growth opportunities? What's the strategy to grow the company? How do you manage it? And so I found myself in 2 specific instances saying, I want to find a leadership role to be able to take my talents and desire to lead more than either finance or necessarily any specific industry. So one of the other things that I laugh about is that my father to this day still loves the built environment. My dad, when he drives down the road, if he sees that a building's being built, he wants to know who's building it. When my dad drives down the road, he sees a beautifully designed building and he wants to know who the architect is. To be perfectly blunt with you, I don't care who's building it. I don't care what it looks like. That's not my passion. My passion is building Walker & Dunlop to be the best company it can be. And we just happen to do a lot of things in the commercial real estate space. And so I think it was that marrying up of my desire to come into a general management role and grow a business where I had a significant equity stake. And that's a whole different story because when I joined Walker & Dunlop, I didn't. And actually, my dad didn't give it to me. I actually had to earn it. But that's a whole different story for a whole nother day. But my point is that I wanted to marry that up. And the final thing that I would say on all of that is this. One of the great advantages I had from going and working in other industries and all over the globe prior to coming to Walker & Dunlop is that I'd been able to see what we could do with Walker & Dunlop. I'd worked at Morgan Stanley. I'd worked at TPG. I'd started an airline in Argentina. I'd worked for a big global outsourcing company, publicly traded. So when I arrived at Walker & Dunlop, imagine that I'd gone straight from undergrad to Walker & Dunlop. What my dad had done and built was all I would have known. And the goal would have been to get a little bit bigger in the DC market. There's Denise Delory, who's on this podcast listening right now. She worked for a wonderful firm called Spalding & Sly in DC. There was another company in DC called Carey Winston, which was a local mortgage brokerage firm, bigger than Walker & Dunlop when I joined Walker & Dunlop. My hope and dream probably would have been, if I'd never worked anywhere else, let's make Walker & Dunlop a little bit bigger than Carey Winston, right? And instead of that, I was able to sit there and say, why can't we be Morgan Stanley? Why can't we be like TPG? And we are nothing like Morgan Stanley nor TPG. Those are great firms, much larger than we are. But at the same time, I think it gave me insight into what the realm of the possible was. So when I came to W&D, it was not let's incrementally change. It was let's make change at leaps and bounds to really grow this company, which quite honestly, I can be pretty straightforward and honest with you. I would have never won the E&Y Entrepreneur of the Year award had I gone straight from undergrad to Walker & Dunlop, because I wouldn't have been able to have that vision of where I wanted to take the company.
Yeah. I'm from the DC area. I visit Bethesda a lot. And I mean, now you have this big, beautiful glass office building in downtown Bethesda, the Walker & Dunlop building. There's a Tate on the ground floor that is very popular. Folks in Boston here know all about Tate. Walker & Dunlop it's a fixture in the commercial real estate world in Washington, DC, of course, but nationwide and now internationally. And it's very impressive. And it's a really cool story to hear how it came from humble beginnings to hand off to you to what it is today.
But Robbie, if I can jump in on you for 2 seconds, because I think one of the things that's very important on that is, to some degree, you need to have, it is helpful to have the sort of chip on the shoulder that I had when I joined Walker & Dunlop. In other words, I would go out to the Mortgage Bankers Association conference and have people say, who's Walker & Dunlop? And I'd be like, oh, well, we're a really great firm. They'd be like, I have no idea who you are. I had people who would say to me, oh, your last name is Walker. Now I know why you have the job you have. You want to talk about getting Willy Walker pissed off? Say that twice. And, it was an insult to me that someone would think the only reason that I was in the seat was because of my last name. And so that kind of chip on my shoulder is what drove the desire for growth and for innovation and for expansion. And that was very, very helpful. And so while I appreciate greatly that you sit there and say, when you come through Bethesda, there's the Walker & Dunlop marquee, and we've grown across the country and now have 45 offices and 1,400 people, and we compete every single day with the largest services and lending firms in the world. And so, it's an incredible thing. I mean, if I had said to you when I joined Walker & Dunlop, one day we will go head to head with CB and JLL on every single engagement, and we will go head to head with Goldman Sachs, Morgan Stanley, JP Morgan, and Wells Fargo on every lending engagement, and we will win, you would have laughed me out of the room. I mean, literally laughed me out of the room. But I think, you don't show up and sort of say, well, we want to just go create that. That happened over 20 years of every single day being in there, growing it methodically. And I would also say not swinging for the fences. I think it's very important. We took some major risk at important times, but at the same time, it was never, oh, we got to get there tomorrow. Let's step up to the plate and try and swing for the fences and hit a home run. And we're going to take undue risk in the process of doing that. It was done with very methodical 5-year business plans that establish bold, highly ambitious goals for the team. We put the team to it, and to the team's great credit, we accomplished those 5-year business plans on a very systematic manner.
It's very inspiring, Willy. Very. And I think especially in the world of commercial real estate, where a lot of people think that it's a good old boys club, right? And it's very traditional industry and it's passed down. But to think that in today's day and age, it is still possible to build from very small beginnings something that can compete with some of the most storied finance and real estate companies in the world, the Goldmans, the Wells Fargos. This might be a good point to pivot. Of course, we're on a podcast here. I'm obviously interested in what you're doing with the Walker webcast. It's just such great content. It's really varied. I think it's always really timely and relevant. And so I have 2 questions for you on the Walker webcast. First is what your goal is with the webcast in terms of what you want your listeners to get out of it, and also what you're getting out of it. And then second, and relatedly, how do you think about the podcast vis-a-vis the brand value of Walker and Dunlop and your own personal brand value?
A lot in there. So on day after tomorrow, I've got John Gray of Blackstone joining me for the 5th anniversary of the Walker webcast. Okay. So the reason I raised that is that it was 5 years ago this coming Wednesday that the world shut down due to the pandemic. And it was actually last Friday, if you want to be concise about when it was. That was when the world shut down. And on that Friday, I called our head of marketing, Susan Weber, and I said, we really need to talk to our clients. Let's put together a webinar for next week. And she said, great. When do you want to do it? And I said, well, it's Friday. We don't want to do it Monday or Tuesday. Maybe we get our act together on Monday and Tuesday, and we'll do it on Wednesday. And she said, great. And she said, what do you want to talk about? Who do you want to have come? And I said, I ought to get some Walker and Dunlop bankers and brokers to talk about what we're seeing, or our, trading desk to talk about what we're seeing on spreads or treasury rates. But, why don't I see if I can get an outside speaker to come on and give some outside perspective? And so I called a gentleman named Sri Kumar, who is a great macroeconomist who has been very prescient on rates in the past. And I called Sri and said, hey, would you like to join me? And Sri said, sure. And so Sri came on that Wednesday, and I think we had 3,000 people live on the Walker webcast, and it was fantastic. And I said, well, that was pretty neat. That kind of worked. And so I said, let's get another outside guest. So I called Peter Linneman, who started the real estate program at Wharton and is an old friend of mine and a luminary in the commercial real estate space. And I said, hey, Peter, you want to come on next week? And Peter came on, and we had 5,000 people. And remember, everyone was locked down, and the only thing they were doing were looking at Zooms and trying to understand what was happening in our world. So that was pretty great. And then I said, let me see whether Barry Sternlicht will join me. And so I called Barry, and he said, sure, I'll come on. And all of a sudden in our registrations, we only had 10,000 Zoom licenses at Walker and Dunlop at that time. And we had 15,000 people who pre-registered to hear Barry and me talk on that 3rd week. And I said, I think we've got something here. So the way it took off was because everyone was, locked down at home, watching Zoom and wanting every bit of information. But there are a couple things that were really important about how it got legs, okay? Because if you remember, everybody and their brother and sister had some type of podcast at that time, some kind of webinar. Our big competitors, all of them had, hey, listen to our experts on where rates are going, where cap rates are going, et cetera, et cetera. We stayed consistent to not talking our own book, but bringing in outside people. So that was a key strategic difference between us and the competition, which ended up winning. Okay. The second thing is our competition would move their webcast around. One week it was on a Tuesday. The next week it was on a Thursday. It was at 9 a.m. It was at 3 p.m. We stayed at every Wednesday at 12:30 East Coast time. So the second thing was the being consistent so that people knew, oh, Walker and Dunlop has one next week. They have one the following week. Whereas even Goldman Sachs, with all their great branding and all their everything that they have, much, much better than Walker and Dunlop, they banged around and their podcast series fell away. Okay. Then the other thing that was super, I think, important to it is that while it really is focused on commercial real estate, macroeconomics, I said people are going to get bored of listening to Peter Linneman and Willy Walker talk about commercial real estate and macroeconomics. Let's make sure we go out and get new, different guests. And so I went out and got athletes. I went out and got CEOs in other industries. I went out and got musicians. A lot of different people to come and interact with me to kind of play into, you're not just going to hear the same thing every week. And so the final piece to it is that it has required a tremendous amount of my time and attention. But I will tell you that there is nothing we could do as a company, nothing, as it relates to building the brand the way we have behind the webcast. We have never paid a guest. I paid one guest, who was Katie Ledecky, who at that time was training for the Tokyo Olympics, and the U.S. Olympic Committee paid her a stipend of $4,500 per appearance. And I said I would pay for what the U.S. OC was doing. But other than paying Katie Ledecky's per diem of $4,500 to be on the Walker webcast before going to Tokyo, we've never paid a guest. That's really hard. And I can't tell you the number of people who have sort of said we've tried to outsource the attraction of guests to the Walker webcast, and it's all my network, it's my friends. And now that it's grown so much, I can go to people and say to them, look, Muhammad Al-Arian was on the Walker webcast in January, and so far his webcast has been watched by 525,000 people on YouTube. Would you like to come on? And there's not a person who has a valuable voice who doesn't sit there and say, whoa, 500,000 people listen to your conversation with Muhammad Al-Arian. Maybe I want to go do that. Believe me, when we were much smaller and I was just trying to get it going, it was really off of my personal relationships to say to someone, hey, can I steal an hour of your time? And then the final thing is, as it has grown, we have a great team that works with me on all of the record it, push it out, take clips, put those on Instagram, take clips, put those on LinkedIn, et cetera, which has grown the kind of viral marketing around what people are saying when they're on the podcast. So now quickly to your other questions. What's the vision for it? It's so much bigger than I ever thought it would be. What it does is I believe we don't make money off of it. We make money off of our brand growing. Right. And so because YouTube pays us for advertising on the YouTube fees, we get a couple $1,000s here and there from our advertising on YouTube. But I don't have advertisers. We don't promote anything on it. It's for W&D, and it's for people to sit there and say, hey, that's what W&D is bringing to me. I might want to work with them at some point. So it's doing exactly that. It's a top 1.5%. And it's funny, I should just say top 2%, but it's not in the top 1% of global business podcasts. Okay, so do I want to be in the top 1%? Sure. It'd be nice if we picked up 50 basis points off of our rankings as it relates to, it'd be nice to be in the top 1% of global business podcasts. And then I think the final piece to it is that it makes me so much better because I do all of my own research. So while I have plenty of people at W&D who help me here and there, I have to go and research my guest to really understand my guest and what makes him or her tick. And so I do really deep research, and it takes a ton of my time. But invariably, I'm doing research on John Gray right now. I guarantee you that as I'm doing my research, I'm learning something about what John Gray is doing at Blackstone that Walker and Dunlop will do sometime in the next year. Guarantee you. So I'm in this every week trying to learn something new, read a new book, do research on my guest, which invariably just makes me a more informed, better CEO. And I will tell you, my management team probably gets a little tired from time to time of me saying, hey, I've just done this on this person. Let's think about doing that. But I mean, I just had the head of Prudential on a couple of weeks ago, and I learned so much in my research on what Pru does. And just this past week, I had Joanna Zabrinsky of BH and talking about why she sold to Pradium and what BH is doing with Pradium as the big alternative asset manager behind them and how they're playing. As you can imagine, that plays into my thinking about Does Walker Dunlop need to partner with a big private equity firm? Do we need to become part of a big private equity firm? How do we play to compete against that huge capital aggregation machine out there of Blackstone, Apollo, Ares, and others? All those things are so insightful and helpful, and having the discipline of researching it on a weekly basis invariably makes me better at what I do.
I listened to that episode just this past weekend. It was a fantastic one. I mean, I recommend it to all my friends, Willie, and I'm not just saying that because we have you here on the podcast. I really do. The few number of my friends who haven't already heard of the Walker webcast, the way I describe it to them is it's not just a commercial real estate podcast. It's a business leadership management style podcast by the CEO of a very successful commercial real estate firm. And often it goes into the real estate world, but anybody can glean value out of any episode, whether it's commercial real estate related or not. And one thing that I love that I always tune into is the most insightful hour in commercial real estate. I mean, you could either spend, I hate to say this, but you could pay thousands of dollars for his letter, or you could just tune in for an hour on the Walker webcast once a quarter.
Well, I will say one thing, Robbie. I will say one thing. The reason he keeps coming back is because the sales of his letter have gone through the roof since joining the Walker webcast. So
there you go.
Peter and I think, just did our 16th or 17th Walker webcast. Believe me, there is a direct correlation in sales of the Linneman letter and the Walker webcast growth. So it benefits us both. Let's put it that way.
Very good. Very good. I'm glad to hear it. So relatedly, I've also noticed that you're a pretty prolific LinkedIn poster, which I love. My classmates would probably tell you I'm a bit obsessed with the platform myself. How do you use social media as a branding or business development opportunity? Do you simply use it as a way to keep abreast of what's going on in the world? Or do you use it similar to the Walker webcast as a way to put yourself out as a leader in the business environment and the business of Walker and Dunlop as well?
Yeah, it's interesting because I think that there is, as I view the world of social media, I view LinkedIn as a business channel, if you will, and I view Instagram as a personal channel. Yet the two are sort of melding across each other. There's a lot of business going on Instagram, and there's a lot of personal going on in LinkedIn. I have far many more followers on LinkedIn than I do on Instagram. And yet there are a lot of things that I post on Instagram that I think would be applicable to LinkedIn. I have a great team, as I said previously, that manages all that stuff and makes sure, that things are getting tagged appropriately, that we're creating clips that are easily digestible, because not everyone wants to sit around and watch an hour of the Walker webcast. And I would say that, there are bankers and brokers at Walker and Dunlop who are extremely good at using social media to promote their brand and our brand, and make sure that they're putting data and insights out there for their clients, and do a very, very good job of pulling from what's publicly available out in social media or other things and posting them up to make it so that their clients can come in and see them doing it. There are others who either don't see the value in it or have missed the opportunity to create value there, which quite honestly, I think is a huge missed opportunity for anyone who is trying to sell their services, whether it's financing, whether it's selling, whether it's appraisals, whatever goes on inside of Walker & Dunlop or outside. It's become a very, very powerful medium. And as you can imagine, I get a lot of unsolicited business opportunities to Walker & Dunlop through LinkedIn, where people write and say, hey, I've got an asset to finance. Would you got a team to go on it? We used to have to go to a convention with lots of business cards and walk around and meet all sorts of people to get someone to say, hey, I'd like to work with you. The idea that can come in organically just because you put things onto social media, it's a gift from heaven, quite honestly. And some people just don't get that. And obviously we try to promote that internally, and we say, hey, this came out of nowhere. The other piece to it is that, as you asked previously, the growth of the Walker webcast and the growth of both Walker and Dunlop's online presence and then my own personal online presence makes it so that I also, get invited to speak a tremendous amount. But the thing that we've figured out, the reason the last two Walker webcasts were me interviewing people at conventions, is that if I go to a convention to speak, and in both of those instances, they invited me to come speak. I go to the convention, I speak in front of a couple hundred or a couple thousand people. And for all practical purposes, that speech dies there. Okay. I go speak, the people who are in the room get it. It's great, done. But they've asked Willy Walker to come speak about what Willy Walker wants to talk about. what I've done is I've said to them now, I'll come, you get my brand, but I want to interview somebody else. So then what do we get to do? We get to videotape my interview with Michelle Herrick of JP Morgan 2 weeks ago, or my interview with Joanna Zabrinsky of BH last week. We do it as a Walker webcast. And not only do the people in the room get that one-on-one personal engagement of, I hope people would think that my guests were great, which they were, and that I asked good questions, but then we also get to go replay it and get all the additional branding around that. And so that has become something that has, again, evolved from just starting with the webcast, then going and creating a really good online presence around the webcast and making it highly digestible, and then taking speaking engagements and, if you will, converting them into an ability to use those speaking engagements as a platform for the Walker webcast, which also helps them. Both of those conferences I went and spoke at wouldn't have gotten the halo effect of the Walker webcast, because I would have gone and spoken to just their people. I come in, I go out, and it's done. Now we tape it. It gets put out on a Walker webcast, and the RetCon conference that I went to last week gets all the additional reps on LinkedIn that has been happening since we published my interview with Joanna. And so I think it is really using social media, kind of old conferences of the past, new conferences of the future, and melding it all together to make it so that it is creating insights and information, which at the end of the day is what people really want. And then also allowing for us to continue to promote the Walker & Dunlop brand in ways that I would have never dreamed of in the past.
I mean, it feels really innovative, very creative. It feels like you guys are at the vanguard of this social media in business kind of movement that today seems ubiquitous, but it feels like Walker & Dunlop are executing on it really, really well. And I mean, I'm an avid podcast listener myself. These conversations you were just talking about in the past 2 weeks, it's like being there in the room without having to go to these conferences. I mean, the exposure that the Walker webcast gives to these really insightful conversations to folks who would never have that exposure otherwise is fantastic. But I do think, too, to your point, the content on your social media posts on LinkedIn, Instagram, and otherwise is very good content. It's data-driven, right? And it's insightful. It has a point. It's not just fluff. It kind of leads into my next question, which is about how much you love data. It's very apparent to anyone who listens to the Walker webcast that a lot of your questions and a lot of your insights are rooted in deep analysis of data. Often your questions are posed from specific metrics, or your responses are grounded in specific metrics. I was curious what you're interested in lately today. What are the metrics that you're tracking closely? Is it the debt maturing this year? Is it the amount of dry powder sitting on the sidelines? Is it more, vacancy rates, absorption rates? What's keeping you up at night?
Everything. I honestly, Robbie, I don't think that I've managed through a lot of challenging times in my now unfortunately lengthy career. I was working in Latin America when we had the Brazilian. They devalued the Brazilian real, which then turned around and had Argentina devalue their currency, and all the investments we'd made in Latin America basically went to zero. Right? I've lived through that. I've managed through that. I was clearly around, just talking about it the other day about, where were you on 9/11? Because I was out at USC, speaking at USC last week. And one of the things I said was, most of you in this room were either just being born or were not yet born when 9/11 happened. So when I talk about where you were on 9/11, it's kind of a foreign thought for all of you, but it was not only a day to remember and a tragic day in American history, but it changed the economics of our nation and the stance of our nation and all sorts of things materially. And I'll never forget, a great mentor of mine that day, where I'm still trying to process it, said to me, the future has changed dramatically today, and you will have no idea how profoundly it's been changed until you look back upon it. And I was like, wow. Obviously, today was a shocking, awful, horrific day, but I didn't know that it was going to have that much of an impact. And sure enough, it did. I was around during the GFC when Fannie and Freddie, who we do a ton of business with, were taking into conservatorship. And I was also around in the GFC when our 60-day delinquencies got to a level where it started to put a little bit of sweat behind my collar. And then all of a sudden, bang, the economy started to heal and things started to get a lot better. And on the pandemic. and when we all shut down and the advent of the Walker webcast, amongst other things. But there were a lot of business issues going on at that time, like President Trump mandating forbearance on all federally guaranteed mortgages guaranteed by Fannie, Freddie, and HUD. Well, as a Fannie Mae DUS lender and a Freddie Mac seller servicer and HUD's second largest commercial lender in the country, that meant that the responsibility to advance payments to bondholders sat firmly with Walker and Dunlop if our borrowers said, I want forbearance. That was about $5 billion of liability that showed up at Walker and Dunlop overnight because President Trump said forbearance for all mortgages. Fortunately, most of our borrowers, almost one of them, showed up and said, I want forbearance. The rest all continued to pay their loans and kept moving forward. But had thousands of borrowers showed up and said, we want forbearance, that would have caused a really big issue. So without going on too much longer, I've lived through and managed through a lot of different challenging times. What I find particularly challenging right now is it feels like the Trump administration wants to change everything all at once. And so it's not just one piece of the equation, it's everything. And so as a result of that, and by the way, I have great hope that this all works out into some fantastic master plan where all the things they're doing come back together into this perfect thing, and that, everything comes back and rates go down and the stock market takes off and rental, occupancy stays high and all the fundamentals of commercial real estate get in there and people start going back to the office more. And I mean, I can riff on this thing for quite some time. It feels right now very disjointed. It is what it is. I think both the Treasury Secretary as well as the president have said, we don't mind that it feels disjointed and we don't mind that we might go through a transition period now. And quite honestly, when you first hear that, you sort of say, wow, well, that's not great. The president's and the Treasury Secretary is saying we might go into a recession for a period of time to get to a better future. And now all of a sudden this morning on CNBC, Jim Cramer and David Faber are sitting there talking. They say, you know what? Maybe we need a little bit of that talk. Maybe, in the past, every president and every Treasury Secretary have been like, oh, it's going to be okay. We're going to throw a little more money at it. We're going to, get the Federal Reserve to ease a little bit more and whatever else. And actually now we might have to get moving and we might actually have to move through some difficult times to get to some better times. And so, again, I would reinforce there's so much going on right now that it's very hard to track. I wish there was a little bit more of a game plan out there that said we're going to do this, this, and this to get to that. But we're not getting it. So it's up to us to try and be nimble, to react, to move effectively. We are fortunate to be a relatively small company. So I can move our 1,400 employees a lot quicker than many of my competitor firms who have tens of thousands or hundreds of thousands of employees. What we sell is a service. And so I don't have big manufacturing costs. I'm going to go and put money into a plant that is either in Mexico or in the United States that is going to be there for the next 50 years. So you need to make a decision today. You're going across the border, you're staying here, you think policy is going to stay in place, you think it's going to change. So we're very lucky in the fact that A, tariffs don't impact us, and B, we recreate our product every single day. It's a challenge because you got to have people who are super bright and know how to recreate that product daily. No deal is the same. No structure is the same. The cost of capital changes every single day. So you by nature have to be entrepreneurial. Once you've created it, you can't just go rinse and repeat, rinse and repeat, rinse and repeat. And at the same time, it provides us with great flexibility as it relates to a macro environment that's moving very fast. But one perfect example of that, Robbie, is this. We announced 6 weeks ago that we were opening an office in London. And when we announced it, I said, you know what? Everyone's going to come in and say, why are you investing in Europe right now? Europe's flat on its back. Nobody's invested in Europe. Europe's growth is done. They're over. And now all of a sudden, lo and behold, 6 weeks later, everyone's saying Europe's the place to be. It's like, that shows you how quickly the narrative is changing today. And I do believe that President Trump is gleeful about that. In other words, I think that that's his strategy. I think that's where he wants to be. I think that's where he wants his administration to be placed. And I clearly believe that that's where the president personally wants to be placed. He wants everyone to wake up every day and say, what's the president going to tell me is happening? Because that's going to dictate the way that the markets go. That's going to dictate the way that Americans go. And I'm sure there are plenty of people who hate that aspect, and there are plenty of people who love that aspect. I'm not going to opine on that one. But as a business leader, it makes it a very challenging time. So back to specific things that I'm focused on. Obviously, the cost of money. So where do rates go? Where does the 10-year go? Theoretically, tariffs should be inflationary. Last week, we got a really good CPI print. And guess what? Rates went up. That's not good. Okay. But then again, today, stock market's up, rates are rallying. I mean, what hurts is when the markets don't go in the way you think that they're going to go. So equities are surging. You would think there's a sell-off in fixed income, and therefore cost of capital goes up on the debt markets. But we've been the exact opposite of that. We've had the equity markets going down and the cost of debt going up. Right. So those types of things are very difficult. And they're not only difficult for us, they're difficult for our customers. And that's where it's really painful, is that what we have consistently said since the great tightening began now 2.5 years ago, almost 3 years ago, is what we need is consistency in rates, because our borrowers can't establish a cap rate when rates are banging all over the place. You get consistency of rates, and no matter where rates are, you're going to be able to get to a cap rate. And then you're going to create a market. And people are either going to be a seller or a buyer at a given cap rate with a given cost of capital. That's what we need in commercial real estate to have transaction volumes come back. So rates bouncing all over the place is what creates inconsistency and a very difficult market for people to make investment decisions. You get consistency on rates, and people, again, can determine a cap rate, they can determine a cost of capital, and they can say, I'm either a buyer or I'm a seller at this pricing. So that's what we are hopeful for, and that's what we're watching. And then the final thing I would say to you is timing. We have had most people delay big investment decisions for the better part of 2.5 to 3 years. And what ends up happening is that loan that was supposed to be refinanced last year 2 years ago that got kicked to last year. The question is, do they kick it again? Does the bank allow you to kick it again? Or does the bank say, you know what, we want our money back? A fund that had a fund life of 7 years that matured in 2024, and they went to their LPs and said, we're going to extend it in our extension period for another year or for another 2 years. When do they have to start selling assets to repatriate capital back to their LPs? All of those things are happening right now, where last year or the year before people said, I'm just going to sit on my hands and not do anything. We very much feel and are seeing in 2025 that sort of the clock is running out for people as it relates to either selling an asset to repatriate capital, buying an asset to deploy capital before they have to return it to investors, or refinancing an asset when the bank or the debt fund or the CMBS lender says, I'm not giving you an extension. And so all of that is going to get transaction volumes going. I would say since January 20th, the market has been anything but what we thought it was going to be, which is back to inconsistency in the capital markets, which makes it very difficult for our clients to make decisions of refi, buy, sell, et cetera.
Yep. Yeah. I mean, I, like you, remain hopeful and optimistic. I also think underlying a lot of this tumult is a level of excitement that things are happening all at once. I mean, I'm excited about some of these efforts as well. Some of them, of course, give me pause too, but I do think that in times of great dislocation, there's also great opportunity, right? And I'm hoping that that's what comes out of this. I am excited about the comments that you make about timing as well, in terms of hopefully there is price discovery, because that's what we need. There needs to be a floor in order for assets to start trading again. So I suppose it remains to be seen, but I have to imagine you're right in the middle of all of it.
Yeah, it's a very, very interesting time, and I would say that it feels as if people aren't sitting around waiting for someone to sort of. I mean, someone was saying to me last week, "Wow, it's never been more difficult to sort of make decisions because there's so many things that are going on." And I said to the person, "When is it ever easy?" In other words, like, when do we ever know where rates are actually going to be a month from now? We never do. I mean, I can run you through example after example where people sort of said the coast is clear, it's a great time to go and invest, and it didn't end up being that way. And the other piece to it is, if I rewind the clock to 2021, when rates were super low and people were paying 3 caps for multifamily properties. And there was this massive, massive herd mentality to go invest, particularly in the multifamily industry. Those are some of the worst investments people have ever made. Worst. So you have to be really careful of what you hope for, because there is sort of this lemming effect of everyone sitting around sort of saying, oh, well, everyone else is deploying capital right now. I better go do it. And I can see my way to buying an asset at a 3 cap. And all of a sudden, boom, the cost of borrowing goes up, exponentially, and your vacancy levels come down and your rents go flat. And all of a sudden that 3 cap is not really a 3 cap anymore. So I do think that there is something about adversity and zigging when others zag. That's when people really make big money. I mentioned when I was at USC last Thursday night speaking, I said to the students assembled, I said, look, if you come out of USC and the job market isn't good, don't sit around and complain about the fact that the job market isn't good. And I said, when Barry Sternlicht and Bob Faith came out of Harvard Business School, they both came out into one of the worst job markets ever. And they both went to real estate jobs right out of HBS and both proceeded to get laid off by the real estate companies that they'd been hired from. And they looked at each other and said, let's start our own firm. This was back in the day of the RTC, which Denise and I remember. Many of people listening to this don't remember, but they went and they started buying loans from the Resolution Trust Corporation. And what emerged from that was Starwood Capital. And then Bob Faith jumped out and started Graystar. And Bob Faith and Barry Sternlicht are 2 of the most successful real estate owner, operator, developers in the country, bar none. And they started in the midst of a really bad job market. So anyone coming out of MIT or coming out of USC who sits there and says, I didn't get that cherry offer from Goldman Sachs to go work in their real estate program and they're going to pay me $250,000 right out of school, and that's great and good. That's a blessing to some degree. No knocks against Goldman Sachs and no knocks against making $250,000 the day you get out of school. But the point is that adversity drives the entrepreneurial spirit for people to go and think about what they're going to do. And the other thing about it is that when everything is roses, it very rarely stays roses for very long. And so the fact that we're dealing with a lot of moving parts right now, that's what life is. That's what business decisions are made on. And it feels a little unsettling right now, but guess what? It's kind of always unsettling.
Yeah. And that's what I've been thinking about a lot as well lately is this feels like such a unique moment in time, right? Of course, but I'm early in my career, and I'm sure it always feels like a very unique moment in time when it's tumultuous. I feel like this is actually a good time, since we've kind of gone full circle back to being an entrepreneur, for us to move into maybe the last portion of this podcast, which is the lightning round. This is something I like to do with a lot of our guests. It's actually an idea I co-opted from another favorite podcast of mine. Just quick questions with quick answers. And I think it's a fun way for you to impart some of your advice in a very brief format. So first question, if you could change any one policy at the federal, state, or local level, what would it be and why?
Pull the caps off of Fannie and Freddie as far as multifamily lending. And why? Because we're one of the very largest multifamily lenders with the agencies in the country. And the cost of capital that Fannie and Freddie provide to the multifamily industry is the cheapest capital out there. And it's also done in an extremely thoughtful and credit-worthy way. And so if the president's mandate to lower the cost of housing in America is to be fulfilled by the Council of Economic Advisors, which supposedly there's a report going to every month, and by FHFA, which Bill Pulte is now the director of, removing the multifamily caps would be a great move towards just that.
Love it. I won't ask you about the privatization of Fannie or Freddie because I feel like that could probably be a whole nother podcast episode, and I know you have a lot of thoughts on that one.
I do.
I'll reroute listeners to the Walker webcast for that. Next question. What's one book, podcast, or person you're listening to lately that's inspired you either in business, real estate, or otherwise?
So I've been listening to the Acquired podcast, which I absolutely love. And I was just going back and forth with the 2 founders and hosts of the Acquired podcast. But Acquired is an acquired taste because it's exceedingly long. It's anywhere between 2.5 and 3.5 hours. But they do deep dives on companies and what makes certain companies and business models fantastic. So the last one that I listened to was 3.5 hours on Hermes. And a little known fact by, I believe, most people listening to this podcast is, I'll ask you, Robbie, of all the publicly traded companies in the United States and in Europe and in Asia, public markets, where does Hermes rank? Let's put it, there are 4,500 companies publicly traded in the United States. I think there are another 4,000 in Europe, and throw in a couple thousand in Asia. So let's just say totally there's somewhere between 8,000 and 10,000 publicly traded companies on the face of the planet. Where does Hermes rank in the size of publicly traded companies?
Ooh, yikes, put me on the spot. I would guess maybe within the top 500.
So they're the 48th largest publicly traded company on earth, and they only are Hermes. So unlike LVMH, which is a big conglomerate of luxury brands, which you could see having a huge market cap, this is just Hermes. This is, if you will, just the shop on Rue Saint-Honoré and all the other boutiques they have around the world. But it's this amazing story about the growth of Hermes. It's now in its 8th generation of ownership by their family, even though they're publicly traded. And it just tells you how they've gotten to where they are, and it shows you how they've scaled the company. And so I love listening to those types of things. And I actually took a lot of data from that one. There's also one on Visa and MasterCard, which talks about the duopoly that Visa and MasterCard have in the credit card space. It's fascinating. Visa and MasterCard run 70% margins. Google, which has a monopoly on search, runs 50% margins. They run 70% margins. The idea they have not been broken up by Congress is just unbelievable. So anyway, it's a really great podcast. I would recommend it to many who like business as much as I do and love hearing how certain businesses were both created and then managed over time.
No, it's great. I'll definitely check it out. I look forward to the Walker and Dunlop episode. Okay, what's the best piece of career advice that you've ever been given?
Oh, when I graduated from HBS and I went down to Latin America, and I was asked to write a business plan for a startup airline in Argentina. I put together the management team, but we couldn't find a general manager to go run the airline. And so my boss in the venture capital firm said, "You're general manager." And I kind of looked at him and said, "I did 2 cases on American Airlines at HBS. I know nothing about this industry." And he said, "You've written the business plan, you put the management team together, you've got great management experience, go do it." So I ended up finding myself running the airline. And one of my longtime mentors, a gentleman named Jack Hennessy, who actually he was a Harvard undergrad, MIT PhD student, going down the annals of history. George Shultz, who ended up being Secretary of State. George Shultz, a stat that many people don't know, he was also Secretary of the Treasury in the Nixon administration. And he pulled Jack out of his PhD program at MIT to make him undersecretary at the Treasury Department for domestic policy. And Jack went on to be chairman and CEO of Credit Suisse. And I'm sitting there with my new business plan, and I'm going in as general manager of this airline. And I just spent 2 years at HBS, where the only thing you didn't want to do was be wrong. All they taught you was have the right answer, right? You're sitting in the case method, you're in the classroom, you raise your hand, you say something. The only thing you didn't want to do was say something wrong, because if you said something wrong, you were pounced on like by the sharks and you were made to feel like a complete idiot. So the only thing you want to do at HBS is be perfect. And Jack sat there, he looked at my business plan and he said, "Willy, I can give you one piece of advice, which is get as many scars as quickly as possible." And I kind of looked at him and I'm like, he's basically telling me to go fail. He's telling me to make mistakes and to learn from my mistakes. And I just spent 2 years of brainwashing of, you never make mistakes. You never want to get anything wrong. You want to be right on everything. And now all of a sudden he's saying, go learn. You're going to make mistakes in a startup airline. Learn from your mistakes. Don't make them twice, but you're going to make a lot of them. Go make them young. You're young. You don't have a family. You don't have to worry about anything. Just go do it. And that advice was fantastic because A, it allowed me to sit there and say, hey, you make a mistake and it's okay. B, learn from the darn thing. And C, you're going to be a better manager if early in your career you've gone into a role which allows you to experiment, to make mistakes, to learn from your mistakes, and to grow.
Excellent advice. Even in academia, I feel like here at MIT, and I got my business degree in New Haven. And in academia, it feels like a lot of the time that you can't be
Dude,
wrong. And this is
In New Haven, you're as bad. You're awful, Robbie. In New Haven, you got to get rid of that habit. You went to Yale, okay? Call Yale, call MIT, and do not say you studied in Cambridge because everyone's going to think you went to Harvard. So no. Call it by its name. Anyway, go ahead.
Fair enough. Fair enough. Thank you. But no, I think it's great advice. Even, like in the walls of academia, this is the place where we should feel comfortable to fail and fail and fail. So that when we get out into the real world, when the stakes are higher, we feel more comfortable doing the same and learning. So I appreciate
Just by
that.
the way, on your Yale drop, Yale is in the first round. They won the Ivy Championship yesterday.
Saw that.
My board member, John Rice's son, Teo, is the captain of the team. They are coming to Denver for their first round game, and I'm hoping I'm hosting the Yale basketball team for dinner on Wednesday night at my house before they play on Thursday. We will see whether we can work all that out. But anyway, go Bulldogs as it relates to their first round matchup here in Denver.
Go Bulldogs. Whip out the podcast studio for the team.
There you go.
All right. Final question, Willy. This has been a lot of fun. And this might be the most important and consequential question that we've discussed today. Is it pronounced multifamily or multifamily?
That's so funny. There have been a lot of, is it EBITDA or EBITDA? Right? It's like so many. There are these things that are out there that it kind of goes both ways, right? I've always thought it was EBITDA, and some people call it EBITDA. A lot of people call it multifamily, and others multifamily. I don't know. I think at the end of the day, one of the things that we have to be conscious of is that we need more safe, affordable housing in America in all formats. Whether it is in apartment buildings, whether it is in single-family detached housing, whether it is in single-family rental housing, whether it is in manufactured housing. I think one of the big opportunities that we have missed for 2 decades is that if you go back to the late 90s, the manufactured housing industry was on fire back then. We were making mobile home parks across the country. And then all of a sudden it became this stigma that, oh, you don't want a mobile home park in your backyard because those are people that you don't want in your community. And all of a sudden, municipalities across the nation said, oh, no more mobile home parks. And so the industry changed its name from mobile home parks to manufactured housing. And it's still, when people authorize for a manufactured housing community to be put into a community, they'd be like, we'd rather have a toxic waste dump than a manufactured housing community. You want to talk about the quickest way for us to build and deploy safe, affordable housing in America. It's get back to doing more manufactured housing across the country. And it's sitting there waiting for us. I was in LA last week and went to a manufactured housing construction facility, which is using all local talent and using all local labor and materials to build component manufactured housing. And it was just fascinating to sit there and watch how they're building it. But most people right now, if you build in LA County, if you build an affordable housing project, you're going to deliver it for somewhere between $700,000 and $800,000 per unit. $700,000 and $800,000 per unit to deliver affordable housing using LIHTC and cheap debt that we put together for Fannie Mae or HUD or whatever to build affordable housing in Southern California. They can put these in place in a modular way, so you can stack them up to 5 stories at between $260,000 and $290,000 a unit. We need to be innovative to be able to bring affordable housing, truly affordable housing, to people, get the bureaucracy out of the way, to be able to deal with our shortage of housing across the country in all formats. So whether it's multifamily or multifamily, whether it's single family, whether it's single family rental, or whether it is manufactured housing or mobile home parks, I say bring it all on.
It's great. You seemed, or you managed to make a joke about an important and consequential question into an actually important and consequential response. So I appreciate that. Another exciting one on that, by the way, is opportunity zones, which Jay Parsons has written a lot about recently. There's some really good research about how opportunity zones have built a lot of low-income housing.
Don't forget that the HUD Secretary Turner in the first Trump administration worked solely on opportunity zones. So you have someone at HUD now who understands the fantastic opportunity that exists in the opportunity zone model. And I'll be very, very excited to see what the HUD secretary does as it relates to taking his experience from focusing on opportunity zones and tries to do something there to create more housing supply in America.
Likewise. Well, Willy, this has been so much fun. And again, really, really grateful for your time. Before we sign off, any parting words for the audience or ways that they can follow you or Walker and Dunlop?
The only thing I'll say finally, I actually didn't think that I was going to raise this, but given that you're doing this from MIT, and I'm assuming a bunch of your colleagues at MIT will listen to this. I didn't go to MIT. I did study across the river from MIT, but I will never forget my second year at business school. I was training for the Boston Marathon, and we were running around the Charles River and running past the Smoots Bridge. And as we went past it on this sunny Thursday afternoon, we looked over at MIT and at the rotunda at MIT, and it was as the rotunda always was. And we ran and went back to HBS. And the next morning we wake up for an early morning run, and I'm with the same group of guys, and we're running along, and we look over to our left as we go under the MIT bridge, and we look to the left, and there is a police car on the top of the rotunda at MIT, literally on the top of the rotunda at MIT. And we'd run the night before, and it had not been there. We wake up in the morning, and it was one of the pranks that the students at MIT had done. And to this day, I still don't get how they got the darn police car on the top of the rotunda at MIT. But it was one of those things that made me realize that the people at MIT just sort of think about things a little bit differently from the rest of us. And so, Robbie, it's been a real pleasure being with you today, and appreciate all that you are doing with your podcast at MIT.
Thank you, Willy, very much. And thanks to our listeners. Keep tuning in this season for more interesting conversations with professionals like Willy. We have a slate of really great guests to come, and we're excited to share them with you. I'm Robbie Mulcahy. We'll see you next time here at the MIT Center for Real Estate.
Thanks to our listeners for tuning into another edition of Meet the Visionaries podcast. And please remember to stay tuned for future episodes by subscribing to our podcast, or follow us on social media by visiting cre.mit.edu to learn more. Until next time, take care, listeners.